Thank you for joining us and welcome to Property Networker, where our passion is helping you achieve your own financial planning goals. We educate and demonstrate how to use property as an investment vehicle to help you get to where you want to be. My name is Stephen Lazar, and we are passionate about property. We are often asked, why NRAS? How does NRAS work? And where is the catch? To begin answering these and other pertinent questions, why don't we look at the types of properties NRAS properties are? As you can see, they could be house and land, or a unit, or an apartment. If you knocked on the front door of the property, you would not know if it were an NRAS property or owned by the person living there. There is simply no difference between them. NRAS, otherwise known as National Rental Affordability Scheme, could be a positively geared investment property in your hand. The scheme originated in the USA and set up here by both federal and state government to encourage investors like you to put a new rental property on the market. In order to receive the tax credit, which will average out to around $100,000 over the prescribed 10-year period, the investor provides their tenant with a rental discount. Aimed at tenants who work in secure careers, yet are underpaid, such as nurses, social welfare workers, teachers, bus drivers, etc. They too wish to live in certain locations, but simply cannot afford today's rent, and are forced into areas that they can afford to live in, which is based on their income. NRAS properties have to be new, located close to infrastructure such as public transport, schools, hospitals, shops, and employment. As the investor, you will secure a tax-free rebate called a tax credit back from government, which is $9,524 this financial year. This amount escalates as per rental CPI over the 10-year period. Last financial year, this figure was $9,124. Your NRAS investment will be managed by organizations specifically set up to meticulously vet your tenants, manage the property, and file your annual NRAS audit on your behalf so that you can secure your tax credit. Did you know there are over 1.5 million families or individuals who currently qualify to be your tenant throughout Australia, and less than 40,000 NRAS properties on the market or under construction? Vacancy rates should be negligible, and if I were your tenant, I would make absolutely sure that I look after your property like it is my own. Otherwise, I'm out on the street paying 20% more rent elsewhere. Can you see the incredible investment opportunity here? Does this make sense? Now, if we look at the numbers and how NRAS properties are positively geared, you'll come to the informed decision that NRAS investment property makes sense. We'll be comparing a non-NRAS property against a property that qualifies under the NRAS opportunity. We are merely demonstrating an example of how to compare two investment opportunities side by side, and all figures presented are merely for demonstration purposes only and can be verified by your accountant or your tax agent. As you can see, both properties are identical and in the same development, with a value of $400,000 each, and in the non-NRAS property, the market rent is $380 per week. In the NRAS property, the rent is still $380 per week, less 20% NRAS discount, bringing the rent down to $304 per week. Not looking so good, is it? We then add in interest-only repayments, calculated using 7% interest rate, where you would contribute $25,537 of interest on either property. Other expenses such as rates, insurance, management fees, body corporate, etc. are then calculated. In the non-NRAS, this amounts to $7,384, and in the NRAS, $7,453, because of slightly higher management fees from the management services company for the value-added services they provide. We then bring in depreciation, a highly effective tax minimizing tool that works out far more tax-friendly for you on a new property than on an existing older property without fail. In this case, we estimated $11,292 for depreciation. Considering all the tax deductions from the above expenses, we are allowed to claim $45,175 on the non-NRAS and $45,244 on the NRAS property. You'll note the tax refund on the non-NRAS property is $9,937, yet on the NRAS property it is a whopping $20,979. Being a non-NRAS property, there is no tax credit due. Yet, on the NRAS property, a further $9,524 is applied as a full tax credit, meaning completely tax-free in your hands every year for the next 10 years. How good is that? Looking at cash flow, you will notice that the non-NRAS investment property is negatively geared by $3,640 per year, meaning the amount of dollars you'll be out of pocket at the end of the financial year. Now, looking at the NRAS property, the excellent result is that your NRAS investment property is positively geared to the tune of $3,484 per year, meaning you may never have to put in another dollar into your investment property ever. In comparing them side by side, you will see the non-NRAS is negatively geared, whereas the NRAS investment property is positively geared. In actual fact, you would be better off by around $7,124 per year by choosing an NRAS investment property over and above a non-NRAS one. Does this make sense? We have demonstrated the financial advantages of investing in an NRAS property. And now, our question to you is, what are you going to do about it? You can be like the 60%ers and wait and see what happens, or you can take action and make it happen for you. You are viewing this presentation because you have probably undertaken a Google search for NRAS or for investment property. We assume the reason is that you have an interest in investing in property and will then most definitely have some sort of goal or outcome, your purpose for wanting to invest in a property. Whether it is lifestyle driven, your goal to retire early, to travel or play golf, how about sailing into the sunset, or simply to secure your retirement at the age that you wish to retire or slow down in. It's your choice. Have you ever wondered just how many, or should we say few, paydays you have left until retirement? If you are now 35 and wish to retire at age 65, you only have 360 paydays left. Is that a lot or a little? If you are 45 and wish to retire at age 65, then you have a mere 240 after-tax checks coming your way, in which you have to plan your retirement with. How little is that? Taking the middle example of 20 years, or 300 paydays left, and you wish to retire on, say, $7,000 per month, do you know you would require to accumulate a lump sum of at least $1,700,000, earning 5% interest, to give you your $7,000 per month? To accumulate this $1.7 million, you would need to put away $3,370 per month with after-tax monies every single month for the next 300 months to achieve your goal. Highly unlikely, we are sure you would agree. Can you afford to put away $3,370 every month after you have paid away your income tax? How realistic is even $2,000 per month? Not very, based on the clients we talk to. Yet, your retirement goal of $7,000 per month remains very real to you. Did you know that less than 28% of the Australian population are ever going to be able to afford some sort of retirement. And the balance? They'll be dependent on the state or on family for financial support. Ask yourself, where do you want to be? By now, you will realize that investing with pre-tax dollars and using property as your preferred investment vehicle will or could help you achieve your financial planning goals. As demonstrated, it could be achieved on less than $10,000 per annum with a non-NRAS investment property, or better still, using an NRAS investment property. By owning a positively geared investment property, you'll be well on your way to achieving your own financial planning goals with very little financial commitment from you at all. Does this make sense to you now? The advice shared with you is not financial planning advice, and any information or figures presented are merely for demonstration purposes only and are to be verified by your accountant or your tax agent. Thank you for viewing and being with us today. Regards, Stephen Lazar from Property Networker.